We make investment decisions based on volatility, whether we know it or not. It's important to understand what volatility actually means and how it can affect us, because by doing this, it can save us lots of money in the long run. I'm Mason Leet, financial planner with Martin Christopher, and today we are clarifying what volatility actually means. Now, for this valuable information, we expect payment of exactly one click of the like button. So do this first, and then we'll get started. You will see even in the thumbnail that I mentioned, volatility does not necessarily equal risk. This is probably the biggest misconception on the topic. Risk is a general term. Risky assets tend to create volatility, but they are not the same thing. Volatility is simply a measure of how much an asset fluctuates in value. If an asset you buy or invest in is priced at $500 at the time, and in history has only been priced between $490 and $510 at different periods of time, then you would consider this asset to be not very volatile, simply because the price doesn't fluctuate very much. Or a better investing example, let's say you invest in something that pays out a rate of return of 2% each year, and no matter what happens, it gives you 2%. That investment is not volatile at all. On the other end of the spectrum, and I think the easiest example to understand, might be Bitcoin, where there's literally a joke about the volatility of Bitcoin. I can't believe one Bitcoin costs $41,000. I mean, $52,000 is a lot of money. How can somebody even afford to pay $34,000 for a single coin? Get the joke? Because the price changes that much mid-sentence? Pretty clever, eh? All right, I'll stick to my day job. But anyways, even though that might be more dramatic, Bitcoin isn't the only example of an investment with significant enough volatility. More conventional assets like mutual funds that hold lots of stocks tend to be pretty volatile as well. When it comes to mutual funds or ETFs, the volatility is based on how much stocks are in the portfolio or the fund compared to bonds, because bonds tend to be less volatile compared to the two, and stocks tend to be the more volatile option. So your typical conservative fund might have more bonds than stocks, making it less volatile and fluctuating less in price. Maybe for this, you might expect an average rate of return of 3% each year, but you can see in the history, maybe the fund dropped by 5% at one point, but also there was one year where it made 12%. That gives you an idea of its volatility. Versus another example might be called a growth or an aggressive fund, which invests more in stocks. And with this, you might expect an average rate of return of like 6%, where if you look at the past 10-year history, it had one year where it dropped 20%, but it also had another year where it made 40% in the 1 year. So as you can see, that's much more volatile. So what's my point with all this? Well, here's where it matters. Let's take the aggressive or growth fund example, which you expect an average of 6%. Here's the thing, because of the volatility, you can have one person who invested a bunch of money just before the investment dropped that 20%. After the 10-year period, even that long, they're not going to get 6% rate of return. It'll probably be lower. Then you can have also another person who invested their money and it was just before it went up 40%. So they're going to be more lucky and they're probably going to get a higher average rate of return than the 6%. Where this can matter is, let's say you're investing for 3 years. Sure, it might look better to invest in the one that's providing 6% average rate of return, but you might be smarter to take the one that is lower volatility and providing 3% average rate of return. Because what if you got unlucky and invested in a bad year? You come back after 3 years needing to take out the money, and perhaps your investment is actually less than what you originally put in. So it's not necessarily about which investment is better, it's more about which is suitable to your goal. This is why it's important to take the emotion out of the equation by having a second set of eyes help you with your plan. You have to consider all the potential outcomes of investing. And more importantly, you kind of have to know what you're doing. If you are looking for some help in deciding what to invest in for your goals, I'm happy to chat. You can arrange that yourself when you're comfortable by going to the description below and selecting the Calendly link. Thank you all for watching, and I'll see you on the next one.